Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Centre. Well, India's growth story has many engines, but none more powerful or more enduring than consumption. With a young demography, rising incomes, rapid urbanization, and formalisation of the economy, India is steadily becoming one of the world's largest consumption markets. But the story is not linear, right? From policy shifts like GST 2.0 and the budget-led income tax cuts to cyclical factors like the RBI rate actions and the rural recovery, multiple forces are at play that will shape how and where Indians spend. Well, staples could be reaching maturity, but discretionary categories could be showing signs of strong momentum. Against this backdrop, we're in conversation with the one and only Gautam Duggad, Head of Research Institutional Equities at Motilal Oswal Financial Services, to understand how they view India's consumption story, the opportunities investors should focus on, and the risk to watch out for. Well, Gautam, thanks a lot for coming down to the studio, and we're looking forward to the next 30 minutes or so. But before we get to you, and we've got plenty of queries, first up, let's listen in to some of the key measures that have been announced in this year, 2025.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees. In the new tax regime, I propose to revise tax rate structures as follows: 0 to 4 lakh rupees nil, 4.8 lakh rupees to 4 to 8 lakh rupees 5%, 8 to 12 lakh rupees 10%, 12 to 16 lakh rupees 15%, 16 to 20 lakh rupees 20%, 20 to 24 lakh rupees 25%, and above 24 lakh rupees 30%.
The Monetary Policy Committee met on the 4th, 5th, and 6th of June, that is today, to deliberate and decide on the policy repo rate. And after a detailed assessment of the evolving macroeconomic and financial developments and the economic outlook ahead, the MPC decided to reduce, which is widely expected, the policy repo rate under the liquidity adjustment facility by 50 basis points to 5.5%.
रिफॉर्म एक अनवरत चलने वाली प्रक्रिया होती है। जब समय बदलता है, देश की जरूरत बदलती है, तो नेक्स्ट जनरेशन रिफॉर्म भी उतने ही आवश्यक होते हैं। इसलिए देश की वर्तमान जरूरतों और भविष्य के सपनों को देखते हुए जीएसटी के ये नए रिफॉर्म्स लागू हो रहे हैं। नए स्वरूप में मुख्य रूप से अब सिर्फ 5% और 18% के ही टैक्स स्लैब रहेंगे। इसका मतलब है रोजमर्रा के इस्तेमाल की ज्यादातर चीजें और सस्ती हो जाएगी।
Well, we got a bit of a booster shot in budget 2025. Then you have the rate cuts and now GST 2.0, Gautam. So how do you see GST 2.0 shaping the consumer behavior here in India? And what could the implications be for the listed universe? Give us your initial take.
Sure. Thanks for having me here. See, consumption is a very large part of the economy. I think 58 to 60% of India's GDP is PFC, which is private final consumption expenditure.
Right.
It's very heartening to see that the government has shifted focus towards consumption after a very long time. You know, in the regime of this government, in the first 2 terms, their entire focus was on building capacity, infrastructure, manufacturing. You heard a whole host of things, PLI schemes.
Yes.
The government's capacity expenditure budget, capex budget as we call it, went up from close to 2 lakh crores in FY19 to almost 11 lakh crores now.
Yes.
So almost 5.5 times jump in 6 years. Consumption got a short shrift.
Yes.
And you would all, have seen in the last 10 years, the growth of low-ticket consumer staple companies has been in single digit on a compounded basis. In fact, not a single consumer staple company in India, in the listed universe, has managed to post a 10% top-line compounding for last 10 years, 2015 to 25. Therefore, starting with this budget, with the announcement of income tax cuts, then RBI joining the party with a repo rate cut, Now government cutting GST, RBI infusing liquidity, all of this cumulatively, I think, augurs very well. While the attention of the media is disproportionately focused on GST cuts right now, and rightly so, because after 7 years of GST, this is a very big seminal change that the government has done.
Yeah.
I think in the short term, obviously, you will see a pent-up demand getting unleashed. We all are reading in the newspapers over the last few days how auto demand has perked up, how e-payments have gone up. And now today also, I've heard somewhere that the rest of the festive season sales are also picking up across categories, be it durables or anything. I think there are 2 or 3 ways to look at it. One is the short-term push that it provides to the consumption demand, especially at the lower end of this consumption pyramid.
Correct.
Because staples is something which perhaps may not seem much of a big boost. If you're, say, consuming one soap, just because the price is down 10%, you're not going to buy 2 bars of soap.
Yeah.
But what it does is, it increases the disposable income of a consumer.
Indeed.
Which he or she can then spend on other items.
Correct.
Perhaps more on discretionary goods.
Correct.
Something which a consumer has been deferring.
Correct.
Because the income wallets have not grown. Let's be very clear. If you look at the data of BSE 500 company on wage growth for last 5-6 years, the wage growth has compounded, or the employee cost as we call it, has compounded at hardly mid-single digits.
Right.
So the income growth of a consumer wallet has not been very healthy, I would say. Second, last few years, the inflation has also eaten into those savings. Leverage has gone up.
Yeah.
We all know the household, leverage has gone up. Savings has come down. So therefore, from a multiple perspective, this tape augurs very well. Now, whether the benefits are visible just this quarter, next quarter, it's a matter of details. But there is no doubt in my mind that it has a potential to unleash at least a mini wave of consumption recovery.
Got it.
Be it urban, be it rural.
Okay, all right. So a couple of points you're making out here, that in fact we will see higher amount of spends on the discretionary space. Staples could continue to struggle. And the other point I'm making, so far urban consumption has been pretty strong. Rural has been lagging. Do you see that trend to continue, or do you think a bit of a catch-up now?
On the contrary, urban has been lagging for last 2 years.
Okay.
Because the income growth was not strong. Inflation was higher.
Yes.
Especially items of urban consumption. Your education costs, transportation costs, communication costs, all of those expenses which traditionally do not get captured in your release CPI, WPI data.
Correct.
They were eating into the consumer incomes.
Correct.
Right? Now, urban should also join the party. Rural has been doing well. If you go by the commentaries of consumer companies for last 3-4 quarters, rural has been outperforming urban. And now with a very good, bountiful monsoon, plus, the harvest season should also be good. And I'm hopeful that even the Rabi should not disappoint. So, you have a very rare situation in last 7-8 years where both urban and rural are looking good. Because when urban was not doing well, that time rural was carrying the mantle. And prior to that, when urban was doing well, rural was suffering right after the COVID.
But now you have both the engines.
Now you have, after a very long time, touch wood, that both urban and rural are coalescing together.
Got it. Let's focus a little on the discretionary spend that you were talking about. Which sub-segments do you see the most under-penetrated as of now, and offering the strongest growth from here on, since you're more bullish on the discretionary thing?
Absolutely. Let me elaborate on that a bit. See, discretionary consumption has expanded like anything in the last 10-15 years. So many new categories have emerged, subcategories have emerged and have become very relevant of late. 10-15 years back, when you talked about discretionary consumption from a listed universe point of view, it hardly meant 4 or 5 stocks. You had an Asian Paint here or a Titan there or an United Spirits there.
Correct.
Today, you have 10 hotel stocks, 10 jewelry stocks, so many apparel stocks, so many footwear stocks. The definition of discretionary consumption itself has expanded. In a lighter vein, we used to have one consumer analyst in our team a decade back. Today, we have 3 consumption analysts, and we are looking to add 4th. So, because the listings also that are going to happen between today and next 12-18 months, plus new age consumer tech companies are also coming to the secondary market. So the point I am making is, when we went from $1,000 to $2,000 per capita, in fact, we had our founder had released a wealth creation report called as Next $1 Trillion Opportunity. The argument we had made that point of time was very simple, that when income goes from $1,000 to $2,000, out of the incremental $1,000 that accrues to a consumer wallet, only $100 will be spent on necessities, while the rest $900 will go towards discretionary consumption.
Correct.
Today we are at $2,800. And in next 5-6 years, I think we should move towards $4,000. Now, those incremental $1,200, where are they going to be spent? Because today, aspirations have been unleashed post-COVID. There are so many new categories which have emerged. In 2010, you didn't have quick commerce,
Yeah.
food delivery.
Yeah.
You didn't have so many hotels.
Yeah.
Plus, even if hotels were there, the desire to spend, the propensity to spend was not there,
Okay.
which has come back post-COVID.
Correct.
So if you look at our model portfolio, the Motilal Oswal model portfolio that we release every quarter, today we have zero weight on consumer staples. We were running underweight for 5 years. In July, we made it zero. So all the stocks in our model portfolio are discretionary consumption stocks.
Okay.
So we have a huge weight on jewelry. Titan has been our long-standing favorite stock.
Yeah.
We also like some of the other stocks in that segment which got listed recently, something like a PN Gadgil there or a Kalyan. We like hotels. We have been holding Indian hotels since 100 rupees.
Right. So,
We like liquor. So we replace Hindustan Lever with Radico Khaitan.
okay, all right. So the few stocks you like, you're talking about the jewelry theme, right? Titan, PN Gadgil, and Kalyan Jewellers. So those are the top stocks that will play from that particular theme. Just a quick query. With regard to these gold prices have spurted up so much, will it hit demand?
I think it has already hit the demand.
Okay.
But the good thing is Indians already hold 25,000 tons of gold
Right.
as per a study. Now that amounts to almost 250 lakh crores of gold holdings,
Right.
which amounts to 2/3 of India's GDP at current exchange rates.
Right.
Because the rupee has fallen, otherwise it would have been much higher.
Right.
Now, what is happening on the ground is because the gold prices have seen a huge spurt in the last 2 years, prices have doubled from roughly 55, 60,000 to I think we are right now at 1.2 lakh per 10 grams.
Yeah.
So what is happening is the exchange of old gold jewelry, the gold which is kept in lockers,
Yeah.
the bars, the coins, they're coming out of the lockers.
Yeah.
And people are using that to purchase new jewelry.
Correct.
So contribution of old gold jewelry exchange to the total jewelry sales has gone up in the last 6 to 9 months. Yeah. Second, the lower weight jewelry is also making its presence felt. So which is 18 carat, 14 carat, new carats are getting invented.
Yeah.
But the point is 650 tons is the annual gold demand in India. And it is very stable because of the demographics. We have a young demography and we have roughly 70 lakhs to 80 lakhs wedding, if my estimate is correct,
Yeah.
which happens every year in India.
Yeah.
Now in every wedding, the gold is always there. Now, depending on, the estimate that you make, 55 to 60% of the annual gold consumption demand is owing to weddings.
Got it.
So that demand is pretty stable.
Right.
So someone who was looking to buy, say, a 50 gram may buy 40 gram or 30 gram. But because the value has gone up,
Yeah.
the realization has gone up, the top line has not gotten impacted much.
Yes.
Right? So, and even from a medium to long-term perspective, I think the demography is going to remain very favorable.
Right.
And at the margin for the last 15 years, we have seen a shift from unbranded to branded.
Right.
Despite 15 years of shift, today also 60% of the market is unbranded.
So
we have a very long runway of growth for some of these listed branded jewelers.
So there's an industry tailwind, there's a demographics as well that's working in favor. And I think when you have gold that goes up in this manner, for an Indian particularly, you have that feel-good factor,
Of
right?
course, the wealth effect comes into play.
Wealth effect comes into play. Let's focus on another theme, that quick commerce theme that you were talking about. Could you tell us what's the investment case out here? And if you had to choose between the two, we have two listed entities over there. We have Eternal, that's done very, very well. And then you have a peer that's trading at a relatively lower valuation.
Absolutely.
So between the two, what is the preference over there? And tell us the investment theme out there. I don't know whether you call for your lunch this afternoon from there, but we'll talk about that later. But tell us.
No, so investment theme is very simple, Nigel, without complicating things. So there is a preference for convenience.
Yeah.
Today, everyone wants convenience.
Yeah.
People don't want to spend time in traffic, right? People are hard-pressed for time.
Yeah.
And quick commerce, food delivery, all of them come there to satisfy that need of consumption. Second, the penetration opportunity is huge. Despite very strong growth of last 4 to 5 years,
Yeah.
quick commerce, food delivery is still primarily a metro and a tier 1 phenomenon.
Yeah.
So we have a long way to go on that front. Third, the cost convenience, right? This industry for last 3-4 years was burning a lot of cash.
Correct.
Now, incrementally, we are seeing player after player raising platform fee, becoming very rational in terms of competition. The number of dark store expansion, they're moderating. We had a very prominent company in our conference, which just concluded less than a month back,
Yeah.
where he spoke about how they're going to look at unit economics, profitability. So there's no doubt in my mind that this industry is going to become very big in the next 5 to 10 years.
Correct.
Now, will all of them be a winner? We don't know, right? But one of those players, today there are 3 that we are talking about, which has got size, scale, and also profitability,
Yeah.
right? Now, one of them will become very big in our view. So today, we are of the view that you have to bet on many players in that industry and then hope that one of those will become very big and you will compound your capital multiple times while you will lose very little in the one which doesn't become bigger.
Correct.
Today, incidentally, we have a buy rating on both Zomato and Swiggy. And we also like unlisted players in this segment.
Right.
So this is a huge opportunity in terms of consumption, both from a consumer tech as well as from a discretionary consumption viewpoint.
All right, very quickly, tech has been under the weather. Do you think that these platform companies could get a larger chunk because, anyway, those guys are not going to, so maybe flows could get a little bit diverted?
I think so. It is already happening. Nigel, if you look at the data, 4 years back, December 21, the weight of IT in index was 20%.
Right.
Today it is 10%.
Right.
And the large cap tech companies, the 5-6 big ones, they are growing they're finding it difficult to grow even at 5-6%.
Correct.
Mid caps is still growing at 15-20%, but they're trading at 40-50 times.
Got it.
Incrementally, the sense that I am getting from both domestic and global investors is that the new age large platform companies are what are going to see more allocation away from the traditional old school legacy tech companies.
Absolutely.
Unless we see a very different macro situation evolving after a few months.
Right.
That's a very different ball game altogether, which we cannot conceive today.
Okay.
But as of now, 5-6% growth is getting 23-25 P multiples, which I think at some point of time market will question.
Correct. All right, Gautam, you've given us a few ideas from the jewelry, from the quick commerce theme, as well as that interesting one, replacing HUL with Radico in your model portfolio. We'll talk more about a lot more stocks. For the time, we will take that snappy break, come back, write to us. We'll push some of those queries to Gautam. Don't go anywhere. Welcome back. You're tuned in to Finding Alpha. You're on CNBC TV 18. And as promised, we're going to take some of your queries. The first query that we have is coming in from Ramesh Jain, who writes to us from New Delhi. He says that the last 1 year has been very good for gold while equities have slumped. He's asking what should be the fresh allocation between gold, equities and fixed assets. Gautam, your answer to him.
So Nigel, this allocation of assets toward different asset classes is a function of two things. Your risk appetite and your age, of course. That ultimately decides the risk appetite. I mean, I'm a believer that one should have allocation across asset classes. I'm not a 100% equities guy. I was a few years back. But now you have 70-80% to equities, around 10-15% to gold, and remaining to debt, which includes your EPF, NPS, bond, and sundry other debt products. Though I'm not the wealth manager, but this is broadly what I feel it should be.
70-80% to equities, 15% approximately 10-15% to gold, and remain to fixed assets.
Again, they need to consult their wealth manager based on their risk appetite.
Absolutely, absolutely. We take that on board. Let's focus on a couple of other sectors then. Cables and wires. The demand has been quite strong. Momentum is expected to continue. Increasing competition was a bit of a concern with the Birlas as well as Adani's coming in there. What do you believe out here? Risk-reward is in favor, keeping in mind that there could be large players that are coming in there, and multiples still, I think, at more than 30 times, even if you're assuming good growth. You believe risk-reward is favorable, and what do you like from the cables and wire space?
So risk-reward was more favorable 6 months back when they made those big announcements. Stocks had corrected 20-25%.
Right.
So look, this is a big industry. This is almost a 96,000 crores industry as of FY25. And growing at 13-14% for next 4 to 5 years.
Right.
So the opportunity is big. And there are credible players there who've gained market share in the last 7-8 years from unorganized guys. But there is still a lot of room for them to gain market share. Right? Because this is an industry which is basically a derivative play on many other sectors.
Yes.
So we like this industry. In fact, recently we just upgraded KEI, which is again a player which has been very consistently growing at 18-20% for more than a decade now. Save 1 year of COVID. Polycab is a name which we've been liking for some time. So Polycab and KEI are these two names which are our preferred bets in cables and wires. But industry is looking good.
Okay.
Just that the risk reward was more attractive 6 months back than it is today.
Okay, all right. And, Polycab, what a story, right? It listed at $1 billion of market cap, 8,000 crores approximately. Today, it's 1.1 lakh crore. And the promoter sold close to around 5% and recovered, I think, close to around 4,000 crores. The entire market cap was just 8,000 crores 6-7 years ago. Phenomenal numbers out there. Promoter taking some part of the pie that he's baked. Let's get another query where Himanshu is writing to us from Pune. He wants to invest in United Breweries and ask at what level should he enter. I think, Gautam, you're a teetotaler, but you're tracking these companies closely. So tell us, what is the view on the alcohol space?
So we are very positive on Radico Khaitan. In fact, that's one of our model portfolio stocks. The stock has done really well. In fact, earnings have compounded at more than 30% for last 2 years.
Okay.
Our in-house view is that, and in fact, that's our estimate, that in our next 2-year basis, the earnings should compound at more than 35%.
Okay.
So we are very positive there, and that's our sole allocation in the liquor sector.
Okay, Radico Khaitan is a stock that you like. Well, the next query is interesting. Rahul Singh is writing to us from Patna. He is holding 20 shares of Trent at a price when Gautam was doing some very, very serious research. I think he was the lone voice on the street who was quite positive. He's got 20 shares at 1,200 rupees. He asked if you can buy more. Now, this is a stock that was 8,500 rupees. It's come down to 4,700, but he's still well in the money. What would your advice be to him?
No, so clearly the price is corrected. The reason for the price correction is twofold. One, you've seen a drop in growth from 40-odd% to 30% and then 30 to 20.
Yeah.
On an absolute basis, even 20% looks very strong because the rest of the players in that category or in that industry are struggling to grow at 10-15%, right? But at 40%, when the P was 115, growth was 40%. The moment 40% dropped down to 20% in 2 quarters, the P is also corrected.
Correct.
Now, this is a stock which is tailor-made for long-term investors.
Yeah.
You know, in the short term, it's very difficult to predict what can happen to a company which is trading at 80, 90p. There can always be some quarterly disappointments in a very long journey.
Yeah.
I mean, this is a stock we've been tracking since 100 rupees in 2012 when market cap was 2,000 crores.
Right.
To now it being a part of Nifty. I still feel that they will outgrow their competitors by a margin of minimum 2 to 3x. Now, whether the market likes it or not is a very different ballgame because valuations are totally different.
Yeah.
But from a 3 to 5 year perspective, I think this company should still create wealth from where we are right now.
Okay.
There can be some more downside left, which we can't forecast because it's a very short-term thing. What if third quarter is bad or second quarter is bad? Those are things which we cannot predict.
Yeah.
But from a slightly longer-term framework, 3 to 5 year, this is a stock where I will allocate money.
Okay, all right, Gautam. Thanks a lot for joining in. You have helped us out with some good ideas that you all, at Motilal Oswal are positive on. Interesting conversation as always, and we appreciate you coming down on Finding Alpha.
Thank you.
Well, that's a wrap on this edition of Finding Alpha. Thanks a lot for watching. Gautam gave us all the insights with regard to the consumption boom that's expected from the Indian economy itself. Thanks a lot for watching.